Hi there and welcome to the weekly general update for the 7th of January, so the first one for the new year. And the first week of the trading year was pretty slow really. The volumes were still relatively light. I guess a lot of traders all around the world are still on holidays, and we may see some higher volumes start to kick in as of this week. So let's just have a look at the normal important information about general advice that you've seen before. So all of the work that we do is on the basis of providing you with information. You need to make your own decisions regarding your own trading. So a bit of a summary of the action for the week that's just gone. The S&P finished 1.6% higher for the week. It was up about 20 points. And that largely all occurred in about the first 15 minutes of Tuesday's trading. So it gapped massively higher on some pretty positive action from Europe, and then just bobbed up and down in a narrow range and held that into the close on Friday. So the feature really was relatively low volume, so not a lot that we can read into that action from the first week. And it's still trading within the overall triangle with an upward bias in the short term, so we may see a little bit more to the upside in the short term. But to me, the pattern really does look like it's starting to run out of puff, and I wouldn't be surprised to see a pullback in the next week or so. Now the ASX by comparison only rose a mere 7 points, or 0.2%. And our market has been underperforming the American market for quite a long time now. So it's quite disappointing. Now looking at gold, gold was quite strong, rose by $50 on the week, and we're back into the 1600 area now. It's possible we still might get a final retest back down to 1445, and we'll have a look at the chart on that shortly. And the fact that the RSI is not yet oversold kind of makes sense that there's still maybe a little bit more room for one final thrust down in gold. But after that, I believe we'd be looking at gold working its way higher from that point. Now silver had a better week, but really the momentum for silver is still not there yet. But when it does turn, it will turn explosively, as we saw last year, where silver moved from $20–30 up to $50 in a very short space of time. Oil was also stronger, and I guess as everyone's aware of the fear over what Iran is doing and the possible interruptions to oil. There's a huge game of brinkmanship going on there, where Europe and America are trying to impose oil embargoes on Iran. Iran's retaliating with threats of closing a shipping lane, which of course is crazy. They don't have the capability to do that with the US Fifth Fleet sitting there in the Middle East. So there's a lot of saber rattling going on, but it is making people very nervous. Now, as I've been covering over the last couple of months, there's some key indicators for the medium to longer term for the stock market. One of them is Italian 10-year bond yields, and anything above 7 is really a concern. It's unsustainable, and you can see in the last couple of weeks the Italian bond yields have gone back up above 7% now. So that's not a good sign for the medium term, let's say in the next couple of months. Doesn't mean markets have to immediately turn around and go down, but it's not a good sign. And when we have a look at the euro, which was the other key thing that I was looking at, and the US dollar index, you'll see clearly that the trends there aren't particularly positive for the stock market either. So the actions to take before we get onto the actual charts. Now with respect to gold, for me the junior gold producers are just really very, very cheap, and it's not just in Australia, that's on a global basis. And they've got so much upside in them that I know we've been waiting on this now for quite a few months, but really has to be our primary focus to stay tuned and pick up on these gold producers, because there really is an awful lot of money to be made on buying junior gold producers. Now, trading the underlying, so actually owning physical gold or trading in gold and silver ETFs, is still a very worthwhile thing to do, because that will remove the impact of the stock market. If there is a stock market panic, then gold stocks will go down, irrespective of the fundamental case. So being in gold and silver as an ETF or the physical is also still well worth doing. But leverage wise, there's going to be a lot more leverage in the junior gold producers, that's for sure. Now when it comes to stocks, I'm not really expecting any massive trends this year, and perhaps unless it's to the downside. And most stocks at the moment are not trading at an extreme of either overbought or oversold, so therefore there's not a great deal we can do in the next day or so. We need stocks to either move up or down, get themselves to a point of relative extreme, and then we can trade from there in the opposite direction. So trading the ranges is still going to be a key focus, and I really think on a big picture view over the next 2 or 3 months that more sideways action is probably a pretty strong possibility. Now let's have a look first of all at the US dollar index. Stock markets, and in fact all financial markets, are really being driven by the currencies, and you can see here this is a weekly chart of the US dollar index. It's against a basket of currencies, but the euro does make up about 50% of that basket, so the euro is still a very significant contributor. Now you can see that we had a very significant fall from the middle of 2010 to the middle of 2011. The US dollar index then just flattened out and has now gone back into uptrend since September. So that's where we're trading at the moment. You'd have to say quite clearly, you can see here on these moving averages they've crossed. The RSI is starting to get up there, but still has further room to rise. So quite clearly the US dollar index is in uptrend. Now we're sitting at the moment right on a resistance level, so a break above that would see us move up to the next level, and the top of the range up here at the moment is about 88.5. Now let's have a look at this through some Fibonacci perspective, and you can see if so we've already broken through that 50% retracement level, so we've gone past that. We've got the next retracement level up at 82.5, so we're probably going to see a little bit more resistance there around 82.5. If that breaks, then I think you're going to see a run to 88 or 89, and that is not going to be good for stocks. So I suspect what we might see in this interim period between 80.5 and 82.5, we may see the stock market move up and down, largely anchored a bit while the market waits to see what happens, and then if we do get a break and a move above 82.5, then we're probably going to see stock markets decline. So that could be coming later in the year. So that's the dollar index. Now the key level for me on the euro US dollar was $1.31 just here. It broke that level, and you can see broke it. This is a daily chart, broke it quite decisively. Now we may get a short-term rebound because that really is quite oversold down there, so we may get a short-term rebound, but the way the euro's going, it's hard to see why the US dollar index won't continue to push higher. So that's why there's still going to be a strong emphasis on short selling for some time yet, until the US dollar tops out and rolls over. Now let's have a look at the S&P. This is the S&P chart on a daily chart. You can see here we've got a big picture triangle that's been forming since really July of last year. Lower boundary down here, and you can see that we're still caught within this range. We're currently sitting at resistance at 1285. We've got the top of the band up here at about 1305, and equally a break below 1220 would be instructive for us. So really we've just got to wait and see. The two boundaries for me are 1220 and 1305, and that will give us an idea of the medium-term direction. Until that happens, we've really just got to wait for stocks to move to a relative extreme. Now let's have a look at our market, the ASX 200, and you can see whilst the US market has been rising quite steadily over the last couple of months, our market has just gone sideways, and really in the last month or 6 weeks in a tightening kind of band. So I think we are going to see a breakout from that band in the not too distant future, but you know, if you're wondering why we haven't been able to do much in the last month and a half, it's largely because the price action has just been getting more and more constrained within this little band here. So that's why trading has been so relatively light of late. But low volatility always gets followed by high volatility, so I don't think it'll be too long and we'll see that break out of there. Now let's have a look at gold. Gold has moved up quite well last week. You can see the RSI here did get down to a level from where we normally get some bounces, but if you take a bigger picture look from the bottom in 2008 on a weekly chart, you can see that the first retracement level is at 1446. Yes, that would see a temporary break of that trend line, but that's still quite possible. We also would bring us down onto these highs down here at around about 1430-ish. So 1430 to 1450 is a possibility. So we could just get one final thrust down in gold. And let's have a look at silver. And you can see silver still, look at the moving averages, still trending down, but I think it's pretty close to a bottoming point where we are now. So that's it for the general update. As I indicated earlier, we really need to see the markets move to a point of being a bit more oversold or overbought, and then we can start to trade from there. So that's it for this week's wrap up, and for members I'll be covering the individual stock selections in the chart update. So that's it. Talk to you next weekend. Cheers.